Very good. Well, hello and welcome to Finspire's Focus on the Market series, third quarter 2020 edition. Glad you've joined us for our summer session. I'm Karam, Finspire's Chief Investment Officer. This is a special report not only to recap the second quarter activity, but also to take a deep breath and focus on what lies ahead. I'm particularly excited today to collaborate with Jeff Schulze, Director of Investment Strategist with ClearBridge Investments. Jeff is the creator, the architect of the Anatomy of a Recession and Anatomy of Recovery dashboards, and we are thrilled to be able to bounce a few questions his way. Jeff, welcome aboard.
Great to be here. Thanks.
As always, we're going to share a mixture of facts, figures, and our opinions. It's important to note that ClearBridge Investments and Finspire are not affiliated. Now, to get that out of the way, let's jump into the market recap. As we are very aware, the first half of the year was full of surprises, twists, turns, and overall a historic series of events. The global economy went into a deep recession and may already be well into recovery mode. Equity markets followed a similar pattern of deeply contracting 34% before beginning a recovery at the end of March that continued through the end of the second quarter. So let's start with GDP. First, we know first quarter GDP contracted by 5%. And we're all bracing ourselves for a large second quarter contraction of nearly 35%. We will revisit the actual second quarter GDP figure after it's released at the end of July in our mid-quarter update scheduled to take place in middle August. But today, instead, we'll focus on some key drivers of this recovery. The S&P 500 nearly closed on July 6th, where it began the year. You can see here at that time, the index was off 1.6% from the start of the year. Jeff, your team has done some extensive work in historically reviewing how equity markets sustain their momentum after tremendous 50-day rallies. Tell us how this rebound stacks up against history.
Yeah, Chris. So generally speaking, when the markets move a long way like they have here, people get a little less optimistic about future returns of the S&P 500. However, when you have these strong 50-day, and when I say 50-day, I mean 50 trading day rallies, usually strength begets strength. So this was the strongest 50 trading day rally that we've seen since 1975, but stacked up against the other ones that we've seen in the last 4 decades. If you look 6 months and 12 months out, the market's up 100% of the time. On a 6-month basis, the market's up on average 9.5%, and on a 12-month basis, the market's up 17.2%, which are well above the long-term averages. So history would suggest, even though we've come a long way in a short period of time, that we're going to see future gains as we move through 2020 into next year.
Right, thanks. We like reminding investors as well that markets can change quickly, right? And the 34% drawdown experienced on the S&P 500 from February 19th to March 23rd has thus far displayed an extraordinary V-shaped style recovery, essentially wiping out almost all of the downturn experienced just on particularly on U.S. large cap equities. However, this headline news does not tell the whole story. The Fang stocks, Facebook, Apple, Amazon, Netflix, and Google recently reached all-time highs, and as a small basket of stocks collectively tremendously outperformed the broader index. Thus, the recent positive S&P 500 results have been driven by a select few companies. The returns have not been as consistent across other asset classes, across the whole investment landscape. Bonds outperform stocks so far this year as interest rates decline and as the Federal Reserve has indicated a zero-rate policy is likely here to stay until 2022. We'll talk more about that a little bit later. Developed non-U.S. equities, small caps, and commodities are still lagging other asset classes by a substantial amount, despite having a very strong second quarter. Jeff, you have some interesting observations about the asset classes within the U.S. equity, quote-unquote, style box. Explain how you describe asset classes to be either more or less defensive during a downturn.
Yeah, thanks, Chris. So conventional wisdom suggests that value is the place that you want to go when you see market volatility or a sustained downturn. And historically, that has been true. But you've seen a paradigm shift in 2005 as we've moved towards secular stagnation and lower for longer type of growth. So what we did here is we looked at the Morningstar style box and we looked at all 5% plus drawdowns that we've seen since 2005. There's been 26 of them. And surprisingly, the areas of the style box that are the most defensive are large cap core and large cap growth. They had the best average performance during those drawdowns, but more importantly, they had the highest hit rate. So out of those 26 drawdowns, how many times did you outperform the S&P 500, the S&P 1500? Large cap core was the best with an 85% hit rate. Large cap growth was the second best at 77%. And more importantly, if you look across the entire style box here, the next closest hit rate that you see is small cap growth. So it kind of makes you rethink, where's the defensive areas in US equities?
Yeah, it could be very counterintuitive to what people think as they allocate their portfolios across various asset classes. Okay, let's jump into some key economic indicators and begin with the wild case of employment. We were on a great employment trajectory before COVID-19 and now in the process of regaining that momentum from the last two monthly jobs reports that have been released from the BLS. The unemployment rate was reported just above 11% as of the last report. And so we have a long way to go before we return to pre-COVID levels of employment, but we are now on the right track. With a weakened economy, earnings growth, as you can see here, has been, as you might imagine, resulted downward or moved downward in the latest projected estimate. But Jeff, you make some interesting observations here in the concept of as asset prices are rising and earnings projections are declining, it would translate to higher levels of price to earnings multiples. And your research tells you that may, when you go beyond the surface here, that may be able to sustain itself. Explain that.
Yeah, so people like to look at a 100-year average of a PE of the S&P 500, and the long-term average is around 16, and people say when it's above 16, it's expensive, and when it's below 16, it's inexpensive. But looking at it on that long of a time frame isn't necessarily comparing apples to apples. So what we did is we looked at the S&P 500's index composition, and we looked at sectors that are more cyclically oriented. We've bracketed them together, which are financials, industrials, materials, and energy. That's the dark black line that you see on the chart here. And we looked at other growth, stability, and defense-oriented sectors and bracketed them together, which are tech, telecom, healthcare staples, discretionary utilities, and REITs. And traditionally, when you have high growth and stability, high visibility into your earning streams, you're afforded higher multiples. And you can see here that really since the late 1970s, you've seen more and more of these growth and stability oriented sectors being constituents in the S&P 500. And today they make up about 75% of the index. So what that really means is using the long-term average for PE for the S&P 500 may not be the right approach today, given the less cyclicality that you have within the index. Maybe instead of a 16 being the average PE, you should think about maybe it's 18 or 19. So I think if you think about PEs and they're a little bit elevated at this point, I think they're elevated because you have a much more defensive S&P 500 than you've had in history.
So it's not as easy just to say, hey, look, the market's up substantially from its bottom. It has to go back lower, right? Well, it's not always as straightforward, especially when you start looking at the breakdown within that S&P 500 index. With the weakened economy, inflation has also remained incredibly tame and well below the targets of the Federal Reserve uses for inflationary measures or to judge interest rate policy. And as we mentioned earlier, it does appear that due to these low inflationary figures, that the Federal Reserve has recently stated that they plan on keeping this zero rate policy for an extended period of time, perhaps through as late as 2022. And this filters right into having very, very low, once again, very, very low short-term rates. And the rates have remained, the yield curve year over year has not only gone from a flatter version of it to a little bit more upward sloping as we get some of these improved economic measures as well. So it certainly looks different from a year ago. But we are back to a zero rate policy, which we had actually for several years after the 08-09 credit crisis. And that's also now finally triggered into low mortgage rates. And this could be a real bonus for consumers. Mortgage rates recently, the 30-year fixed mortgage rates recently came down to their all-time lows of 3.13%. After a bit of a credit crunch, if you will, in this space that was eased by the Federal Reserve during the second quarter, it certainly has now trickled into the mortgage rates hitting their all-time lows, which is potentially a really good bonus for consumer activity. Our keys to sustaining the recovery are illustrated here and carry over from our last webcast in mid-May. We have moved outbreak mitigation from thumbs up to both thumbs up and thumbs down. It's what I call the COVID conundrum, where you have cases rising, but you have death rates falling, which puts states in a very difficult, and private businesses for that matter, in a difficult spot to find the right balance to generate economic activity. Oil prices went from a move that from thumbs down to thumbs up, given the fact that the negative prices on oil, price per barrel of oil actually has now since stabilized itself to a seemingly sustainably positive figure. It stands closer to $40 today. And lastly, the fundamentals on the far right have gone from a thumbs down to a thumbs up and a thumbs down, as the late second quarter economic data suggests a recovery is well underway. You can capture our previous market updates along with the status of each of those keys to recovery via our website, finspireme.com, or on the Finspire YouTube channel. And we're looking forward to continuing our socially distanced interaction.